Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets, the world of wealth management, and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. Thanks for taking the time out of your busy schedules to join us. We are recording this so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson. We will have a Q&A period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we invite you to feel free to ask questions. HighRock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April to help build our private client business, and we're off to a great start. We have added a number of new families over the past few weeks, and we are talking to many more that are thrilled with the direction that we're taking. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. We're not brokers, we're not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Now, most financial or investment advisors are not paid to manage money. They are paid to gather assets and find a mutual fund or a third-party manager to place your money with. In fact, many advisors will place their client money with HighRock. This means that those clients are paying fees on top of fees. In essence, our private client group is intended to take out the middleman and save our clients money. Importantly, all of us at HighRock have our money invested in the same models as all of our clients. So whatever we do for all of us. Our interests are aligned with you, our clients. Our fees are simple, transparent, and we take our responsibility to you, our clients, beyond what is required by the regulators. Okay, speaking of interests being aligned and transparency, the Ontario Securities Commission recently released an academic research paper on mutual fund fees, and we thought you might be interested in what they concluded. Funds that pay additional commissions to advisors tend to underperform. Higher costs tend to equal lower returns. And here's one that I found to be outrageous, because a goals-based strategy should determine risk tolerance in conjunction with the client. It should not be the advisor making a unilateral decision on what risk the client should have. And finally, advisor compensation is not necessarily clear and therefore can be confusing. Further, certainly not all advisors are solely driven by commissions. However, how does an unsuspecting investor determine which advisor is being totally transparent? That is what makes HighRock different and better. Total transparency, no gray area, and no conflicts of interest. Okay, so let's move on to the risk analysis section of our weekly calls. Here we are always trying to seek the most efficient way to maximize returns while at the same time minimizing risk. Our goals for your portfolio strategy are to get the best possible returns and take the least amount of risk to do that within the scope of your goals and risk tolerance. With our measure of risk along the horizontal axis, increasing from left to right on this page, a pure equity portfolio like the S&P 500 or the S&P TSX indices have significantly greater risk, while in comparison our research shows that a 60% equity, 40% fixed income model can significantly reduce the risk and still achieve an annualized return of between 7 and 8% over a multiple year period, optimizing the risk and return factors. So in the context of our risk analysis, let's check in on our broad economic themes for 2015 and assess the risk of some of the latest developments. The U.S. Federal Open Market Committee met last week and announced that they were not prepared to raise interest rates yet, but that economic conditions were expected to be able to allow them to do so starting to start raising interest rates in 2015. Now, the FOMC committee members revealed their interest rate expectations out to 2017 and beyond, and this was represented in what they called the dot plot, which is part of the Fed's attempt to give forward guidance to their expectations. As they see an improving economy, they see the potential for interest rate increases, and that's borne out in this chart. Now, over the past few years, their forecasts have been overly optimistic. So we also have to make our own assessments as to the direction of interest rates in both the short and the long term. But it's interesting to see what the Federal Reserve governors and voting members are expecting. Now, if we take that information and extrapolate an average of those expectations out for the next year, we can see at this point the Fed could likely be raising rates approximately 6 times between now and the end of 2016. Now, all things have to remain equal, economic growth continuing as they expect, and of course, core inflation returning to their 2% target. In Canada, how do we expect this to play out? Well, that will depend on how the Canadian economy responds. At the moment, the Bank of Canada Governor Paulos is counting on better U.S. economic growth to lead Canadian economic growth. In fact, economic optimism amongst central bankers is becoming a recurring theme. And that plays into another one of our 2015 themes. Central bankers don't like volatility because it undermines the confidence, and they want to instill confidence in the economy. Uncertainty forces consumers and businesses to put economic decision-making on hold, and that can put the brakes on economic growth. But current economic data are forcing many analysts to question, and ourselves as well, the rosier outlook being portrayed by the Fed and for that matter, the Bank of Canada. So if interest rates do move higher, we want to be able to assess what impact that will have and adjust our fixed income strategy accordingly. Last week, we looked back to the 2004-2006 period to see how rising short-term interest rates impacted longer-term interest rates in the U.S. And in Canada. Now, while the past does not guarantee the future, we also know that those who do not learn from the past are doomed to repeat it. Our assessment is that we should have a longer-term duration in our fixed income strategy. So more on that in a minute. But first, let's look at some of the latest economic data that we've seen over the last week. Yesterday, the Chicago Fed's National Activity Index failed to continue to bounce as it had the previous month. So the longer-term trend still seems to be pointing downwards. However, housing starts are continuing to trend higher, as are new home sales, which we actually saw this morning. Other data we saw today, U.S. durable goods orders for May show a slight downward move, but basically over the last while, durable goods orders have been quite flat. So we're not seeing a whole lot of economic growth out of this number. Data from Europe show that after an uptick in consumer confidence earlier in the year, the last few months have seen that trend stall. And while this is just a sentiment number, it is still struggling to get into positive territory. And as I said before, confidence is something that is important for central bankers. And this obviously is an important piece of data. Okay, so let's look at what's happening on the inflation and deflation front. The latest U.S. data on inflation show that after the more volatile food and energy components are stripped out, inflation continues to remain subdued. Now, on Thursday of this week, we'll get more data, the core PCE index, which, in fact, the Federal Reserve targets. So we'll have an update on how that looks next week. But generally speaking, U.S. inflation still rather benign. In Canada, the core inflation index dipped, but it actually remains high. And to a larger degree, that's because of a weaker Canadian dollar. In the euro area, inflation has ticked higher in recent data, and the deflationary trend appears to be coming to an end. And this is having some impact on European bond markets at the moment. UK data turned up slightly, but not enough to end the downward trend just yet. So again, we'll continue to monitor how that unfolds. And in an interesting development, Japanese inflation turned down sharply in more recent numbers and precariously close now to renewed deflationary scenarios. So again, something to keep in mind on a global watch. Okay, well, bond markets continue their volatility over the question of inflation returning, and of course, we can't ignore the Greek situation, which appears to be coming close to a head. And then speaking of the Greek situation, Paul was interviewed on BNN yesterday and had some pretty interesting thoughts on what might transpire as they close in on their deadline for debt repayment. So, Paul, do you want to enlighten our clients a little bit on what your conversation was on BNN?
Thanks, Scott. Well, it was quite general in nature, but really what I did say was probably relates more to the currency, the euro. Because they're in a single currency over many countries, and really you've got Germany and some of the other more developed nations, mostly to the north, that appear to have a booming export economy. Germany is one of the few countries in the world that actually has a capital account surplus right now, and that's because they have a weak euro currency. If Greece does exit the euro, that means the euro currency is going to strengthen, and that will hamper German exports, which is not a great thing for the core European community. And then there's a prospect that Portugal may want to exit, Spain may want to exit, and they would want to exit because they would want a weaker currency themselves. So Greece would go back to the drachma, for instance, and have a weaker currency. So that's, in a nutshell, that's kind of what I was talking about.
And the implications of that ultimately, as you said, are probably negative for the European economy if the euro starts to strengthen, and that could force the European Central Bank to be more aggressive in their monetary policy as far as stimulus concerned.
Yeah, that's a good conclusion. Agreed.
All right. Well, that should play itself out over the next couple of days, although history has shown us that they tend to kick the can further down the road more often than not when it comes to these issues. So we'll keep a close eye on what's going on in Greece and definitely be reporting back to our clients next week. So let's have a look at bond markets. We have since the low yields in April seen bond market volatility driving a steepening of the yield curves, and we've talked about this on an ongoing basis. But 10 years and longer are adjusting higher, and that certainly plays into our strategy for extending the duration of our bond portfolios. So our next buy points, and this is something that Paul and I have been working on over the past week, but our next buy points, we've targeted those if we do see further increases in yields to try to capture some of that opportunity in both the U.S. and also in Canada. So that's definitely something that we're monitoring very closely. And also in other developed countries, we've been watching German yields rise. Yields are rising in the UK, and even yields are rising in Japan, although most recently they've ticked lower and probably in response, I think, to some weaker inflation data. Okay, so what about equity markets? Well, we're sticking to the theme that we still think that they're expensive, and how that impacts our client portfolios from a risk perspective. What risks do we see? Well, technically, after last week's FOMC meeting and the better understood situation as far as how the FOMC was thinking about short-term interest rates, that uncertainty removed, the S&P 500 found buying support, and as a result, enough so to push it back up through that short-term downtrend line, which means that once again the uptrend continues. And even though to date the S&P is only up 3%, there seems to be some renewed technical interest. For us, though, it's also about the fundamentals. And as we have talked about often on our call, we still think stocks are expensive. Now, if investors are currently waiting for earnings to catch up to prices, it looks like they're going to probably have to wait because the expectations for second quarter earnings, which start to get released over the next few weeks, those expectations are expecting earnings to decline by about 4.7%. So stocks will remain expensive unless we see a more significant correction. So basically, we're comfortable waiting for that correction, and that will happen when investors realize that they own overpriced equities and they're not getting much growth for that that amount of risk that they're taking. And when they start to reduce that risk, then selling will begin, and you know, that'll happen when it happens. So for the time being, we have to remain patient. So how are we positioning our portfolio models based on our assessment of the current environment? Well, let's talk about our models. Fixed income, as I mentioned earlier, with bond markets still being volatile, we think that we've got some potential for buying opportunities. A few weeks ago, we took advantage of this weakness and added a small amount of 10 years. We have not added any since, but we are looking for better entry points. After last week's FOMC meeting, we did determine our buy points for bond purchases, and as we discussed earlier, we also believe that there is a structurally strong demand for longer-term bonds due to the current and future financial regulations that are taking place around the world in the banking and in the pension sector. So we believe that there's going to be some decent demand out there at a certain point, and we want to make sure that we own that part of the curve to take advantage of those opportunities that we think will come along. Our global equity model, we continue to exercise caution, but and waiting has been paying off because opportunities are developing. Although prices in Europe have rebounded, we watched as German equities have bounced off their lower prices last week, but the downtrend is still intact. So again, we have to monitor it, make sure that if the downtrend is broken to the upside, we may reassess our buying strategy. It's important for us to always be nimble. We've been watching developments in China, and volatility there has increased significantly after hitting highs on June 12th. The Chinese prices have dropped by a significant 11.5% in just 2 weeks. So that's something that we're monitoring closely as well. And at this point, it's not impacting other emerging markets because they've also followed the general equity market trend higher recently, but again, still within the confines of the downtrend that started back in April. So again, monitoring trends here, and again, waiting and being patient about buying opportunities. As far as our Canadian growth equity model is concerned, we thought it might be interesting today to spend a couple of minutes on our stock selection process to give our clients just a little more understanding about what we're looking at. And I'm going to ask Paul to jump in here and just talk a little bit more.
Okay, thanks, Scott. First of all, we did add a new name to the Canadian growth equity model last week, a chemical manufacturer, which is one we've known for a while, and we know one of its competitors very well, but we're we did initiate a position in that last week and added to it just yesterday, so that's a new position. So we hold a few positions in that model and always looking for more opportunities, but again, value is the key. So I'm only going to spend about a minute here and go through this flow diagram just to give you a sense for what we do when we look at a stock or a corporate bond. So we start in the top left, idea generation. So we share office space with two other OSC registrant firms that are basically hedge funds. They're pretty bright guys, so we share a lot of idea generation with them and a lot of research and company meetings. For instance, we have a call tomorrow with one of the chemical companies we know quite well. We have a call with their treasurer, and all three of us will be on that call. Then when we're looking at a company, we open up an Excel file. So we have an Excel file on any position we're in, whether it's a bond or a stock. And these are fairly detailed models that we create and monitor on an ongoing basis, most certainly quarterly conference calls. And that's number 3. That's a sort of note tab. Number 4 is cash flow modeling. Cash flow is extremely important both for stock and bonds. For bonds, cash flow pays our coupon interest every 6 months in the bonds at maturity. And for stocks, that's really what we're buying is a stream of cash flow. So we want to analyze that cash flow as best we can. Number 5, we're looking at a corporate bond. We're doing credit analysis, which entails looking more at an indenture. So it's another layer of analysis on top of stock analysis. An indenture is a legal document. It's about 250 pages long, and they're very they're filled with legalese, and they're tough to read at times. But I've been doing that a long time. But I read through every one before we enter into a corporate bond trade. We look at competitors to do relative value analysis to see how cheaply it's trading, what the assets look like, etc. Number 7 in the top right, we look at various operations segments that company may have and see what their value is. And then we establish entry-exit points, which I think we spoke about it 2 or 3 weeks ago, Scott. And we may use charts, which you've seen a lot of charts here today. So once we do our fundamental work, or our analysis, we will look at charts and say, we think we should buy here, or we may want to sell there, and that gives us a bit of discipline on our entry and exit points. And then number 9, the bottom right, is just review and repeat. But once we're in a position, we are always in front of our Excel file. So this is a fairly detailed amount of work. I don't want you to think we're picking stocks or bonds in any sort of ad hoc or willy-nilly way. I would argue that the work that we do through this investment management process would be much more detailed than I would hazard a guess than any investment advisor in this country would do. So it's fairly high-level work, but that should give our clients and interested listeners an idea as to what we do when we look at a new stock or a corporate bond.
Thanks, Paul. And certainly one of the things that we hold in high regard at HighRock is the ability to have this communication with our clients so that they get a sense of the work that we do, but also so that if there are questions along the way that they wish to have us address, that they do so. And you know, we want to make sure that we're accessible and so that people who want a deeper understanding of some of the things that they own in their portfolios, they're more than welcome to ask for that. Okay, thanks again, Paul, for that quick overview. Let's talk just a little bit about our website. We've been updating our website with a number of changes, and certainly big thanks to our summer intern from the Honors Business Administration program at Wilfrid Laurier University. Well done, Mitch. Thanks so much for all your efforts. So if you have a chance, please check out our website. Mitch has done a lot of work, and we think it's pretty accessible for everybody. And there's lots of information in there, and certainly, if nothing else, our contact information so that you can certainly ask questions when you wish.
And Scott, if I could just interject as well, well, some of our listeners and clients are looking at the website because it is new and it's been a work in progress since Mitch joined us about 6 weeks ago. Feel free to give us feedback, things you like or dislike, especially dislikes. We can contemplate making changes.
Yeah, absolutely. Okay, and another bit of housekeeping. Also, don't forget to check into the High Rock Challenge survey on our website if you've not already done so. Also, feel free to send it to your friends. We want to get as much feedback on our thoughts about looking after our clients as much as we can. So we've offered up a very serious prize, so we want to make sure that everybody gets to it. Okay, that's it for today's discussion. And if anyone has a question, please feel free to jump in now and ask.
Hey, Scott.
Yeah.
I actually have maybe it's an observation, but isn't it interesting that Japanese stocks are going up, yet they're moving towards deflation, outright deflation, not even, well, it's still maybe disinflation, but it's on the verge of becoming deflation, and Japanese bond yields are going up. That's crazy.
Well, it's monetary stimulus, and if I do recall, the Central Bank of Japan is allowed to purchase equities to help with the stimulus program, and I believe obviously that's probably being impactful on the stock market. And I hope that makes sense. But again, as we have been talking about, the valuation is just something that we're very aware of, and certainly that's something that is something that we really want to make sure we're keeping a close eye on. But it doesn't appear that we have any other questions out there, Paul. So if people do have questions, of course, please feel free to send us an email or even give us a call. But that's it for another week, and we certainly want to thank you for taking the time to tune in. Have a wonderful week, and we'll be back with another webinar next Tuesday.